Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are looking at someone called Ray Dalio. Ray Dalio is a multi-billionaire and he is one of the co-chairmen for Bridgewater Associates. They have, over 20 something billion dollars in asset management. So we will look at their portfolio today and see if some of the companies they invested in. Now, I like to do this because I just want to get an idea of what the big boys and girls out there are invested in, not just to copy, but just to get inspirations and ideas. And that's all it is. And if I find a company they invested in and I think that company is decent enough, then I'll do my research before I actually buy that stock. I'm not going to buy it because they're buying it, okay? And some of the companies that we're going to talk about today, Ray Dalio has over $1 billion. So to put $1 billion into one stock, they must think that company it's really a good company, because you don't put $1 billion. Some of these guys have got so much money, right? And they don't, a million, couple of millions is not a lot to them, but $1 billion, that's a lot of money. So that's one of the things that we're going to do today. But before we get started on this, I want you to stop doing everything else and just give this video a like. Okay, subscribe to the channel if you haven't already. It takes a lot of time and effort to put these videos together. I would really appreciate if you can do that for me, because it takes, like I said, I've always said to you guys, having a full-time job as well as having a family, and then trying to just basically create these videos week in, week out, is becoming a little bit difficult at the moment, I'll be honest with you. So it'd be really nice just to kind of give the videos a like. Hopefully more people can come and see the videos and we can appreciate obviously the growth of the community, inshallah. Right, let's have a look at the first company that this guy has actually got in his portfolio. At the end of the video, I'm going to show you his entire portfolio so you can see it yourself. So as usual, we got 10 companies here. We got the ticker, we got the company sector, dividend yield, 5 years. All of these companies do pay dividends as well. Years dividend increases, safety, profit margin, free cash flow, return, total returns, and then the growth for the next 5 years. And then as usual, Morningstar valuations, and then the fair price that they're expecting. Right. So the first company, one of the his biggest companies, and I think he's got $1 billion in this company, is Procter & Gamble. This is in the consumer staples. It's one of the companies that I own in my portfolio. They have 2.5% dividend yield, 5-year growth rate of just 4%, payout ratio 61%. Years, they have increased this dividend for 65 years, and they have 99% safety, which is the highest you can get. Profit margin 18. We're normally looking for about 15, which is really good now. Okay, free cash flow about $14 billion, and total returns over the last 10 years, we're looking at about 11% there. And then growth in the next 5 years, we're expecting about 5%. Right now, according to Morningstar, is 17% premium, okay, or $124 per share. Basically, that's what the price should be. So price entry will be about, fair value will basically be $124 per share. And that is one of the biggest companies and they have over $1 billion in that one single stock. The next one is J&J. And they got about over $700 million in this company. And as you can see, it has 2.54% dividend yield, 6% growth over the last 5 years. Payout ratio is quite low. They have increased this dividend for almost now 60 years. And then safety is 99%. They have profit margin of over 20%, free cash flow almost $20 billion, and then they've returned to investors almost 12% in the last 10 years. Growth next 5 years is expected 5% every single year for the next 5 years, and again it was 7% premium, $167. The reason these two companies are expensive right now is because everyone is moving away from basically the tech side of things, the high flyers, and moving into companies that have sustainable business that are going to be around for a long time, companies that can basically weather the recessions and all of these things that are happening right now. Okay, and for that reason, this stock has been going up for a while now. The next one is Visa. They've got about $100 million worth of shares. And right now, as you can see, they have a 0.74% dividend yield, 15% growth in the last 5 years, payout ratio very low, and they have increased this dividend for 14 years, 99% safety, okay, profit margin 51%, which is absolutely amazing. It's $15 billion of free cash flow here. And then last 10 years, they have returned about 21% to their shareholders and 18% growth in the next 10 years, next 5 years. For every single year, they're expecting about 18% growth. Right now, it's discounted about 11%. $229 is the price target for that company. The next one is Exxon. ExxonMobil is the energy sector, 4% dividend yield, 3% growth in the last 5 years, payout ratio only 51%. Okay, I was quite surprised when I saw that. In fact, 5 years, they have increased this dividend for 39 years. Okay, so they are dividend aristocrat. They're heading for dividend kings right there. Safety 80%, profit margin 8.34, free cash flow $40 billion. Now they have a lot of money in there, but they use so much of it as well. So oil companies tend to have a lot of cash. They need it, to be honest. Okay, and the last 10 years you would have basically received about 3%, and this is one of the reasons I don't invest in oil companies, because the returns are not that great. But right now they're doing amazing, so I wish that I had a couple of these companies in my portfolio. Right now, next 5 years they're expecting about 23% of basically earnings growth, again coming from almost nothing to where they are now. And then over the next 5 years, 23%. They look like energy stocks are about to, they're not going to go anywhere anytime soon. Fairly valued at the moment, $96 per share is the price target for that company. The next one is Apple Laboratories. This is in the healthcare, 1.72% of dividend yield, 12% growth in the last 5 years, 33% payout ratio, and the last basically 50 years they have been increasing that dividend. Safety 71%, profit margin 17%, and then free cash flow of $8 billion, which is very, very healthy. And then the last 10 years you would have received about 9% total returns. And then when you look at the next 5 years, they're expecting about 13% growth in the earnings. Fairly valued at the moment, and the price is $104 per share right now. That's basically what they expect. Okay, the next one they own in their portfolio is Starbucks. This is it has a 2.47% dividend yield, which is quite high. Okay, I mean high for this company, because I didn't think it was actually that high, to be honest. 5-year growth rate 17%, payout ratio 58%, and then for last 11 years they haven't been increasing that dividend. 67% dividend safety, profit margin 14%. They've got about $3.6 billion of basically free cash they can spend on all sorts of things. Free cash flow, like I always said to you guys, is very important, because it allows companies to actually pay off debt, buy back their own shares, pay out dividends, okay, as well as reinvest in the business to grow the business, acquire other businesses. There's so much they can do with that money, so it is very important. Okay, 13% total returns, 5 years. Next 5 years they're expecting about 8% growth. Right now it's about 21% discounted at the moment. The price should be about $100 per share. That's basically what the Yahoo Morningstar is saying right now. The next one is another company that I own in my portfolio. That's Medtronic. Is in the healthcare, basically healthcare equipment side of things. 3% dividend yield, 8% 5-year growth rate. Payout ratio is 45%, so they have room to grow that dividends if they want to, and 44 years of increasing that dividends. Safety is 99%, so they've got enough cash of $6 billion, but profit margin is about 16%, total returns 11%, and the next 5 years they're expecting the business to grow about 11%. Right now it's 31% discounted, is $129 per share. That's basically where that company is. The next company we're looking at is Colgate. Colgate is one of the companies that the Bridgewater Associates own. Is a consumer staples, 2.4% dividend yield, 3%, which is quite not nice. I would have expected this type of big company to at least give. Actually, the Procter & Gamble is only 4%. So yeah, 3% is decent. I guess it's okay. I like 5% or more. Okay, 3% 5-year growth rate, payout ratio 57%, dividend years. Basically, they are dividend king. Okay, so almost 60 years right now. Safety 90%, profit margin 11%, almost 12%. Free cash flow $2.5 billion, and it has a 6% basically return, 6% to investors in the last 10 years. In terms of next 5 years, we're expecting about 4% growth and 4% premium right now, $75 per share. So it was down quite a bit, not down, it was up quite a bit, and then it came down a little bit again. So right now it's actually expensive, so I'm not touching it. I'm not adding more to this Right, Striker is very similar to Medtronics. They both sell healthcare equipment. Okay, 1.38% dividend yield, 11% growth, 29% payout ratio, which means they can definitely increase that if they wanted to, and 30 years of paying that dividend or increasing that dividend if you like. Safety 90%, profit margin 11.56, free cash flow here we're looking at about 2.4 billion dollars, and total return in the last 10 years you're looking at about 15%, which is really good. So this is more Medtronics and basically Striker are kind of growth stocks in the health sector if you like, okay, because they have to basically innovate every couple of years, obviously, because that equipment is needed, right? So 8% in the next expected 8% growth in the next 5 years, fairly valued at the moment, $195 per share. And final company is Kimberly-Clark Consumer Staples, 3.46% dividend yield. I'm sure you know this is Dividend King. Okay, 5 years of not Dividend King yet, it will be Dividend King very soon. 5-year growth rate of 4%, payout ratio 80%. So this is one of the reasons I've actually sold this out. 80% of payout ratio, that's quite high for consumer staples company that is not really innovating anytime soon. 5-year growth rate, 15, almost 50 years of increasing that dividend. Safety is 88% because of this, so they can actually pay the dividends, but I don't like that payout ratio. That's too high for me. Profit margin is below 10%, which again another red flag there. And when you look at the total returns over the last 10 years, it's actually better than Procter & Gamble, and not better than Procter & Gamble, but it's better than Colgate if you like. Okay, they are similar sort of a company. Next 5 years, they're expecting 5% growth, fairly valued at the moment. $126 per share is what Morningstar is saying is the fair value for this company. Right, so that is the list of the companies that I've extracted from the list of these companies Ray Dalio and his hedge fund actually own. Let's have a quick look. So as you can see here, there's this website called Hedge Follow. I've just put his name and his portfolio comes up, and as you can see here, his big holdings in here is the Vanguard FTSE emerging markets. So he loves the emerging markets, if basically side of things. And if you don't know who he is, by the way, is this guy here. Okay, I'm sure you've seen it on YouTube and so on. He doesn't not like cash. He always calls it cash is trash and whatever. Okay, so as you can see, Procter & Gamble is about $1 billion there. J&J, as you can see, I think it's 770. They've also has a Coca-Cola, PepsiCo, companies like that, McDonald's, Walmart. So it looks like he likes the consumer staples. He likes the predictability of these businesses. Okay, he does also have companies like, I think this is one of the Chinese companies in there. He's got Pfizer in there, Stryker again there. You've got JD.com there, Kimberly-Clark's, Cisco there. He's got Neo as well. That's interesting. So they have so many different. They also own a bit of Berkshire Hathaway as well, which is the companies owned by Warren Buffett and so on. Kroger's, Exxon's there, Lin. So they've got so many different, well diversified. They also have some emerging markets, ETFs, and so on. So that is what I wanted to share with you guys today. That I hope you're enjoying the videos. I hope you're enjoying this kind of content. Again, like I said, it's not just to right now go away and start putting all your money into Coca-Cola or Procter & Gamble or whatever. It's just to give you an idea what these hedge fund guys are invested in, and then do your research and see if it's a good fit for your portfolio. Okay, and again, like I've always said to you guys, I'm not financial advisor. I do own some of these companies in my portfolio. Okay, not because they own it, it's because I did the research and I feel like this is the type of companies that I want in my portfolio. I hope you can appreciate that. I hope you can give the videos a like, subscribe to the channel if you haven't already. Have a wonderful day. Assalamu Alaikum.